You are not live.
Are we live? Yeah, we're
We are
live.
live. We are live. I'm trying. Yeah, I'm trying.
We're good? Checking connection. You'll be live
I'll be
eventually.
live in a second.
We're all live. Hi, everyone.
Hey, how you guys doing?
Okay, I'm live here with William Caban from Cross Country Mortgage.
That's right.
Everyone knows who I am. You could tell people who you are.
So my name is Will Caban, the mortgage man. I'm with the Lemon team based out of New York, New Jersey, and Florida.
Obviously, he's from New York. Hear the accent.
For Brooklyn, based out of Miami, and working with Cross Country Mortgage. So we're a team that's 14 people, and we work Tri-County.
Cool. Okay, I'm doing a whole series just to give you guys a bit of an intro. I'm doing a whole series called, like how do you get, to buying a home? And I want to focus on the 4 first steps. And number 1 was to get a mortgage pre-approval. And I did a poll on my Instagram. And I asked people, what is the first step in buying a home? And I'm like, is it getting a mortgage pre-approval or searching online? And I had probably 83% that were like, oh, mortgage pre-approval. But out of all of the people that answered that, it was all realtors and real estate attorneys or whatever. I'm like, no, because usually a lot of people, they start their search online even before getting a pre-approval. I'll get emails, from potential buyers that are like, can I go look at this home? And I'm like, are you pre-approved? And they're like, what's that?
Right.
People have no idea how annoyed we get.
Yeah, I know. It's the truth. I think, as with all things, the first step is always the most important step.
Mm-hmm.
And in buying a home, the pre-approval is really the most important step. So I'm interested in knowing some questions that people had revolving around pre-approval. Mm-hmm. And also just kind of going into some of the details of why the pre-approval process is important, mm-hmm. and then your experiences with clients who haven't been pre-approved.
Okay, so first of all, everyone knows if you've worked with me, unless you're like a past client that I know that you have money or that we've worked together, back then, or if you're a cash buyer and I know that you actually have the money, not just because you have a nice car, because that's like everyone in Miami, right? But if I know that, you're a cash buyer or you're selling something to buy another one, I usually don't even show one property if I don't have the pre-approval. And the reason for that is that my time is really valuable. I give 200% of my time and my energy to everyone that I work with, and I'm not going to waste my time. Hi, Mark. That's one of my favorite clients, Mark Jones. So I usually don't even show a property unless the person is either pre-approved or shows me a proof of funds. And the reason for that is I used to work in mortgages. I used to work at Scotiabank back then in Canada. And I know the importance of the pre-approval because even as girls or even guys, I like to shop around, right? Do we go shopping around, unless you have an unlimited credit card, right?
And I don't.
Me neither, I'm not there yet. But hey Megan, should that come fist too?
Hey Megan, how you doing?
Okay, so do we go shopping if we don't know how much money we have in our bank account?
No.
Exactly.
At least, okay. Some people probably do, so you shouldn't do it. If you do, then you shouldn't do it. But most people don't do it.
No, they don't. And the other thing is, I'm like, why do you spend all that time online and even go to the point where you click to request a showing if you don't even know if you have the money? You don't even know, you could be looking at a $500,000 home and you're qualified for zero,
Exactly, 100%.
Why would you do that? Exactly,
and that's the component. Most people think, the pre-approvals, I have money or I have income and I have a good credit score because Credit Karma told me that my credit score is good. But it goes much deeper into the whole aspect of getting a home. And the 4 major components when you're getting pre-approved, it's this. It's credit, it's assets.
Write it down, guys. Credit,
assets, liabilities, and income. And if you want to remember that, just remember Cali, right? California, Cali, C-A-L-I. And those are the most...
C-A-L-I?
C-A-L-I.
What is it? Repeat it.
Credit, assets, liabilities, and income. And each component works in unison. It's basically like a piece of a pie that creates the entire home buying process. And the pie is success, right? That's you closing on a loan and you closing on the property, you getting the home of your dreams. But you don't know what you qualify for unless you actually go through the pre-approval process. So you have to take every component and you have to look at each one, or at least the loan officer has to look at each component. And even realtors can take these tools and just kind of, back of the napkin type of situation and kind of pre-approve your client. And when we talk about credit, we're talking about credit score, but it goes into deeper details like significant credit activities like bankruptcies, what chapter bankruptcies, foreclosures, short sales, pre-short sales, things like that are extremely important to the viability of you getting approved as a borrower. When we talk about assets, we're not talking about your car's worth. We're not talking about that piece of art that's hanging on your wall. We're talking about liquid assets, what you can actually dispose of.
Like money.
Right. Checking accounts, savings accounts, retirement accounts.
And quick question, a lot of people ask me that, can somebody go into their 401k to use the money as a down payment?
That's how I bought my first 2 houses. So the answer is yes. But here's I'm going to take it one step further and tell you that you always want to check with your 401k advisor just to make sure it's something that you can do. But here's the basic tenements and the basic rules when it comes to 401k or just retirement assets when it comes to relative to down payment and closing costs. You can take a certain percentage. Thank you. You can take a certain percentage of your 401k assets and you can actually apply it. I can't start my live video. That's fine. You can take a certain percentage. In most cases, here's the finite rule.
Sorry, guys.
No, it's all good. You could basically take 50% of your assets up to a maximum of $50,000. So I'm going to give you 2 examples. The first example is very simple. You have $20,000 in your 401k. What's 50% of that? Well, $10,000. You can take $10,000. In most cases, you can amortize that out, take a loan out for 15 years. If you have, let's say, $150,000 in your 401k, a little bit different scenario. In that scenario, you can take a maximum of $50,000 for the purpose of retirement and for the purpose of purchasing a home. So that's kind of where that comes into from an asset standpoint. And I'm going to fix that in a second. And then from a liability standpoint, we just look at car loans, student loans, credit card debt. If you have child support payments, we're looking at that as well because that is a liability. Even if it carries on for a short period of time, it is a liability. You are on the hook for it. And then from an income standpoint, we're looking at whether you're self-employed, whether you work for a company, how long you've been at that company, how long you've been self-employed, and all those dynamics. And some of the questions that we have, we're going to go into that and kind of go over that. I'm going to fix this real quick on the live side.
Okay, perfect. And I'm going to talk about just my experience with assets and liabilities and whatnot. And the reason that, because I'm live on Instagram too. So if you guys are following me on Instagram, William is just fixing it for me. Sorry guys on Instagram. So I know people that have a really large income and make a lot of money, but at the same time, they weren't able to get pre-approved for
a loan.
The reason for that is, hello Instagram. The reason for that is because their credit wasn't good, or there's people that have, hi Peter, there's people that have a lot of money, but they don't have any savings.
Exactly.
So one of the biggest questions, we're going to go into some of the questions that always come back and that people ask me beforehand. Okay, what is a good credit to have before starting to look for a property? And what I'm going to add to that is, like, how does a lower credit affect your purchasing ability?
So to answer the first question, normally we want a credit score of at least a 620 to cover all bases from a conventional and an FHA standpoint. Doesn't mean that you can't get financed with a lower interest rate lower FICO score, but 620 is really where we want it to be. Now FHA would allow you to do financing up to 580.
Okay.
And VA would allow you to actually, it really doesn't even have a FICO limit, but 580 is also the limit.
What is VA?
So VA is for our veterans. I tend to specialize in veteran loans. So anyone who's served in the military, who's active duty, who has served in the reserves and put their time in and is in a position to actually qualify for what we call a veteran loan, they would be in a position to actually take advantage of that type of loan. So you have a few different types of loans. And we'll get into that in a second, but I want to answer the core question, which on the surface should be 620, but if it's not, you can go down to 580. Now, before you get even into any of that, the first thing that I would suggest anyone does is check your credit score. Now, there's different schools of thought on this, but Credit Karma, in my opinion, is the Zillow of credit scores. It is not accurate when it comes to credit scores and credit reporting. So my advice is look at your credit card statements, look at your bank account statements. I'm almost guaranteeing you that there's a FICO score component in there. And
on the
that's
credit
what
card,
we use.
usually, yeah, on the
Absolutely.
credit card. And, you know, a lot of people will tell me, I don't get why our Credit Karma told me I'm at 700. Then when I look on my credit card, the thing like
It's
credit
totally-
wise or whatever, like they're like, oh, it's like 30 points lower. So,
Yeah.
and I like to tell that to people. Think about the worst case scenario.
Yeah.
Whatever credit scores you look at, if one of them is like 650, the other one is 675, the other one is 700, think in your mind that you're going to get 650 as your
100%,
FICO.
100%. We're just look at the worst case scenario of all those numbers.
And how does that affect, like, okay, let's say someone, okay, $500,000 house, right?
Right.
One person has a 620 credit score, the other one has a 750. What's the difference?
So the major difference is credit risk, right? We're in the business of lending. I have an unlimited access to money, but that comes at certain restrictions and certain guidelines, one of which the FICO score is going to be a real big determining factor as to what your qualifications are, if you can get qualified, and how much you're going to be qualified for, and most importantly, the interest rate. Because if you're at, let's say, a 620 credit score, it doesn't mean that you're a bad credit risk. It just means on the totem pole of credit risk, you're more of a credit risk than someone who has, say, 720. So from a pricing standpoint, you might get, and I'm almost guaranteeing you're going to get a higher interest rate because of that credit risk.
Also, the interest rate is based on the credit risk.
Yeah, it's based on the credit risk. There's a few components that will tie into the actual interest rate, but the biggest factor, the largest factor, is your FICO score, because you have down payment that will affect it. You have your purchase price will sometimes affect it depending on the lender and the investor.
And another thing, HOA, people like always forget about that. Like if you're buying, you think that you're pre-approved for $200,000 and then you can get a $200,000 condo. No. Because if the HOA is like $400, you can't.
No, it's true. So there's two really important components when it comes to pre-approval. It's your purchase price amount, but then there's also what you can afford on a monthly basis. So if I tell someone, same scenario, $200,000, you can afford a $200,000 home or $200,000 townhome, but you can only go up to a maximum of, let's say, $1,400 in monthly payment. The HOA plays a huge component.
So for those who don't know, maybe there's people in Canada, HOA is Prêt de Condo in Montreal. It's like the condo fees. Like, so if you're buying a condo or like a house that's in a community, there's usually a fee that you have to pay monthly.
That's right.
For the maintenance. And then the mortgage, it's not like a hidden fee that the mortgage lender won't know about. They know about it.
Yeah, we know about it.
Okay.
We know about it. We factor
Because I have
it in.
people that are like, oh, well, do we have to tell the lender? And I'm like, yeah.
We factor it in. It's one of the, you don't see it as a monthly payment. It's not part of your monthly payment when you pay it to us on the lending side, but we definitely do factor it in, mainly because we don't want you to be in a worse payment scenario if you can't afford the property. So it is extremely important
because
to understand that.
the association can't put a lien on the property if you
100%.
don't pay it. So
100%.
So the lenders want to make sure that whatever they're, so I like to explain it to people that way, right? Imagine you have a friend, right?
Yeah.
The friend is like, hey, give me like $100. You're like, ah, sure, you're my friend, here's $100. But if your friend is like, oh, can I borrow $500,000?
It's like, wait.
You're going to be like, well, what's your income?
Yeah.
What's your, it's just.
My first question would be, did you pay me that $100 back that I first?
Right? Exactly. But then that's all, because people are like, well, I don't understand why they're being so complicated with me. I'm like, they're not giving you like a little credit card. It's like a huge loan that they're giving you.
It is.
So like,
it is.
Think about it this way.
That's credit risk. That's the associated credit risk. And all those components, credit, assets, liabilities, income, all of that plays into credit risk, right? You have a lower debt to income ratio versus someone else who might have a higher debt to income ratio. Pricing will be affected by that. You're a higher credit risk because of that. All of those components, each one has a certain factor. So credit in and of itself is going to play into the interest rate. Assets are going to play into how much you can afford. Liabilities are also going to play into how much you can afford on the negative side, because we have to deduct that from your actual income. And then income also is a component of how much you can afford if you're self-employed. over the average of 2 years.
We're going to get over the self-employed just a little bit later. Another question I think that goes with the whole credit thing. So imagine you have the good credit, you have the income, you have everything, and you get this awesome pre-approval. And that came from a friend, and that was an excellent question. So if I have a pre-approval, usually the pre-approval is good for, let's say, 2-3 months, for example.
90 days usually. What
if I don't find the home that I want during that time? Is the pre-approval going to be good after?
Yeah, so that's a great question.
Just the one thing that I'm going to add, like before talking about it, what I did tell her is I spoke about interest rates, so I'm sure you're going to talk about that.
Yeah, absolutely. So it kind of like relative to the first question, what would happen after the 90 days? Usually the reason why 90 days is the magic number is because your credit report is usually good for 90 days. The documents that you give us initially, and we'll get into that whole process of documentation, but the documents that you give us, those usually expire within 90 days, and any associated debts that you might have within 90 days, we want to just see if there's any major changes. So in that scenario, after 90 days, what we would do is we would repull credit. We would just probably get some updated income statements, and we would basically see if you're still where you need to be, and then just reissue a new pre-approval letter.
And what happens if the interest rates went down or if they went up?
So
everything else remains the same.
Absolutely. Yeah. So your affordability in most cases, and depending on where your debt to income ratio, might change, right? I work with buyers all the time who are in a situation where we're max right at that level where their debt to income ratio is gonna be affected if the interest rates go up 25 basis points or 50 basis points. And that is something we have to factor in. And to be very honest with you, when I have clients in that situation, I don't mind getting granular with them and saying, look, and even with my realtor partners, if you find a property, send me that property beforehand so I can run the numbers on it really quickly to see if it's even worth looking at. And if it is worth looking at, here's what we need to be aware of. Maybe high taxes or HOA is there, but something relative to affordability. If it gets really close to the debt to income ratio or qualifying factors, I'm going to ask, send me the property details. So it's very important to understand and work very closely with your lender. You don't want it to be, I get a pre-approval in month 1, and then you don't speak to them for a bunch of months, and then all of a sudden you come back.
You put an offer.
Right. You know, and that's extremely important.
And I think also, like, what people don't get is the interest rate. Like, I'll tell people, like, and I had this happen just now with a buyer. I mean, if you were pre-approved 3 months ago, or like even 6 months ago, and you even got a raise at work, so you think, oh, I'm going to be pre-approved for more. But what happened is that the interest rates really went up recently. Yeah. So if, just to give an example, if you were pre-approved for $250,000 and you were looking in that range, well, now you might only be pre-approved for, let's say, $200,000. Yeah. Which really limits your options. So let's say you were looking at one neighborhood, now that you're approved for less, you're gonna have to like change neighborhoods and change even the type of houses. And even if you do find a house that's $200,000, people don't even think about taxes. Yeah. Okay. You can have two $600,000 homes. One of them, the taxes are $4,000, and the other one, the taxes are $10,000. So
right, and that's the biggest, in my opinion, the biggest component to looking at houses. That's why having an awesome realtor like Sarah is really going to put you in a position to understand the metrics of, well, are the property taxes for this type of property in line with the neighborhood, right? Because if they're not, taxes usually just go one direction and it's up. But if they don't, because I don't want to be pessimistic about it, because they can go down, but if they don't, you're going to start. The lender's always going to qualify you based on
the maximum amount.
The property taxes that are there. So that's something to be very aware of, because the way the market works is you can have, 1, 2, 3 ABC lane and 1, 2, 3, 5 ABC lane right next to each other. And the taxes could be wildly different because somebody owned it, they didn't live in it, it wasn't a homesteaded property, things like that. So that plays a very important factor into the qualification factors.
So speaking of qualification, another question, and I know that I have like the people that join, there's a lot of attorneys, there's a lot of self-employed people, including me, you're self-employed, we're all self-employed, we're all struggling, well, not struggling, we're not struggling, but we all have to pay for everything, we have to, tax-wise, we have to be really careful. So when you're self-employed, how does it work if you want to get a mortgage? Can you get a mortgage?
Yeah, absolutely. So if you're self-employed, one of the biggest benefits of being self-employed is obviously we have a lot of freedom. Financially, we have a lot of freedom. Time-wise, we have a lot of freedom, but that comes at an expense in some cases. In most cases, when it comes to purchasing your home, you take advantage of the tax deductions that are available to you, mainly because of the fact that that's part of the expenses and things that you have day to day running your own business, right? So
I have a really good question.
From that standpoint, what ends up happening, and these are the basic tenements to being self-employed. The first thing is you should be self-employed for at least 2 years. That's
declaring taxes, self-employed
for at least 2 years. And this is really important why you brought that up, is because here's one very, very, very common situation. Well, I've been self-employed for 2 years, but we only have 1 year filed taxes, because the 1 year filed taxes, the second year is on extension. The beautiful thing about being self-employed is you can extend your taxes out the following year until October. But you want to purchase a house now in July. We can't do it. It's going to be very difficult because we don't have taxes. Now, if you accelerate your taxes and you file earlier than the deadline in October, there's a good possibility we can do that. That's the first thing. The second thing is we have clients, like you said, who've been technically self-employed for 2 years, but because of the fiscal year of their taxes, they only have 1 year filed taxes. So we technically, in most cases, will have difficulty getting self-employed borrowers.
Can you talk about having a good accountant?
Oh man, so the first key is having an amazing accountant, and I know you know many of them, but that is the first most important key. Because
you can have an accountant that tells you, oh, declare everything as losses.
Yeah, exactly. and this is it's also the onus on you as a self-employed borrower. If you know that next year you want to go buy a home, you should be planning that with your accountant now. Because what happens is the accountant's going to understand what the deductions are, and they're going to understand where some of these deductions can actually be added back, like depreciation and things like that, where you actually take that off, but we can add that back as income.
Absolutely. So again, you have to work with a good realtor, you have to work with a good mortgage lender, and you have to work with a good accountant. Those are 3 key people, and also know a good attorney, which I know an amazing attorney, Natalie. She's the one I send everyone to. But you guys have to understand, like even I personally, like let's say I want to buy a home, I'm going to make sure I speak to the lender and say, listen, next year I want to buy my home. What do I have to put on my taxes? And how do I have to do my tax if I'm going to be perhaps looking at this price range?
Absolutely. And that's
really
huge. It's extremely important. And look, there are alternative products out there, right? I'm doing a bank statement loan program for a self-employed borrower.
Yeah, so there's different options, but the interest rate is going to be.
It's going to be different. So you pay for it.
Can you give me the example of an interest rate for
a
loan?
So for a bank statement loan?
Yeah.
So it's be like in the 7% range. And you'd probably be paying about 2 points. But here's the thing, right? So
you can refi after.
You can refinance after. So we always use, like, this type of product is usually like a gateway product, as we call it. It gets you into the home. And when you get into the home, 6 months,
you get your stuff together.
Get all your stuff together, and different people have different reasons for filing.
It's true. It's true.
So in this one scenario, it was completely, it's a personal reason, and we can't go back and amend and file large taxes. So but on a bank statement, they're making a decent amount of money. So we can use that as income because we have supporting evidence that there are.
So basically, bank statement loans is when you look at the deposits.
Yeah, we're looking
at account for 2 years.
Exactly, right? We're looking at deposits. We're netting out any one-time large deposits, and then anything outside of that, any of the deductions, we're going to use as income. So we've worked and saved many deals, especially on my team. My partner, Glenn, he's done a ton of them. So I can tell you with confidence that if we have an alternative product and it makes sense and we go over all the terms with you and it's available, we'll do it. But on the surface,
that's like the last.
That's usually the last. Yeah, it's usually not your first option. It's definitely not going to be your first option.
It's really like you want to buy, absolutely. You're gonna have it.
Exactly.
Like different situations.
Absolutely.
Okay, so before we go into the next question, I want to answer a question we got on Instagram that was really good because we spoke about getting the pre-approval.
Yeah.
And then for how long it will be good for you.
Yeah.
But the question I had is, what if I get a pre-approval and then, if I don't find a home and then you have to reissue a new pre-approval, is it going to affect my credit?
So that's a good question. So in most cases,
thank you for asking on Instagram.
Yeah, thank you for that question, because that's a good question. That's actually probably the number one question that I get when
Even people do the pre-approval. They're like, oh,
Yeah.
I don't want to.
I don't want to pull my credit because it's going to hurt my credit score. And here's a few facts about that. So the first is, will it change your credit score? No. It's not going to change the natural attrition of your credit score, because if 90 days from now, if your credit, if there's a significant credit activity or event, like you didn't pay a credit card, or you were late on your car payment, you didn't pay your student loan, something like that, then your credit score is probably going to go down naturally, right? Not because we as a lender decided to re-pull your credit, but it's probably going to go down because that's just the natural attrition of your score. On the flip side, it could also go up, or it can stay exactly the same. But the short answer is no. By re-pulling your credit, nothing is going to change, and nothing negative is going to happen by having a lender re-pull your credit. Now, a little asterisk on this, because this is extremely important. One of the few things that you can actually do is re-pull your credit. I want to say an unlimited amount of times, but a reasonable amount of times, for the purpose of shopping for interest rates, shopping for fees.
So the lender is going to ask you, why did you pull your credit a few times?
Absolutely, 100%. And we just need it's a basic letter. We call it a letter of explanation for credit inquiries, and we just chart them out. We say what is, where any.
Because if you're shopping around for a mortgage lender, you're going to go in different places
100%.
see which one you feel the most comfortable
Absolutely.
working with. And then, like, if they pull it up, they'll see, okay, you went to 4 mortgage companies.
Exactly.
It's easy to explain. You're just like, hey, I was just shopping
I
around.
was just shopping around.
Okay. Another question that we have, and that one is like, I don't know why we didn't talk about it before. How much money should I save up before even going to pre-approval?
So there's no hardline rule on this one.
I like to tell people the minimum is what, 3.5%.
Well, you should usually have your down payment, right? But there's different sources of assets that you can use towards your down payment and towards your closing costs. For instance, you can get gifts from relatives. I know a lot of my clients would, they'll just get married and they get a bunch of cash from being married, so we can use that towards down payment. But how much in assets you should be prepared to have for cash to closing purposes, I would say anywhere from 6, and this is where property taxes and HOA and everything else comes into play, anywhere from 6 to about 8 to 9% of whatever the purchase price is, you want to be prepared to have in assets. And the reason being is because you have your down payment, and that can be anywhere from 3.5% to 5% down if you're looking at just
which is the minimum.
Yeah, the minimum. So if you're a first-time home buyer through conventional, you can actually in most cases go down as little as 3% on a conventional loan. Problem is, if you do that, your private mortgage insurance is going to be a little bit higher, so you're probably better off just putting 5% down. On an FHA, you'd be putting 3.5%. You can put a little bit higher if you want to at 5%, and your mortgage insurance would actually be less. Not significantly less, but it would be less. So for a lot of clients, we're looking at 3.5% to 5% down, which is probably one of the questions. Do you need 20% to put down on a property?
No.
Absolutely not.
No, you don't. The only thing is PMI, which is annoying.
Exactly.
So PMI is mortgage insurance, and what does PMI do?
So basically, there's PMI basically is you're paying, it's insurance to cover the possibility of a default of a mortgage. That's really what it is, right? So the same way you have insurance on your car.
That all goes with mortgage risk.
100%, 100%. It all ties into mortgage risk. And to be honest with you, PMI does affect your affordability because it is an additional payment that you have to make. So the short answer is it is really just a risk factor that you pay for. And if it's a conventional loan, automatically after you hit 78% loan to value, it drops off. If you have 80% and you do an appraisal, in most cases, you can go back to the mortgage lender, whoever is servicing that loan, and you'll be in a position to drop
basically
that.
Let them know, like, my house is worth that much more now. So, like, my loan to value isn't the same.
Exactly. It's not under. We're not below or higher than 80% loan to value.
And I want to add one thing with the down payment and the how much money should I have down. So I've had situations where people come to me and they're like, hey, I'm approved for $400,000. Awesome. Let's go look at those like big houses and everything. I have the money down. I'm good and everything. And then after just doing just even mortgage calculator, I'm like, hey, are you good paying like $3,000 a month?
It scares them.
They're like, what? No, right now I'm paying $1,500 for rent. What are you talking about? So it's not because you're pre-approved for a certain amount or you have the down payment that you're going to be comfortable with the mortgage payments every month. And maybe you will be comfortable, but guess what? You can't go on vacation anymore.
No.
You can't go out to eat anymore.
No.
There will be no food in your fridge or furniture in your house.
You're not living, basically. It's basically, I always say you're paying to put a key into a door. That's what you're doing.
Exactly.
That's all you're doing.
So it's not just the down payment, but after talking to your lender, then you look at the mortgage, because the payment every month, it includes taxes.
Yes.
It includes the PMI if there's one. It includes home insurance, which is another huge component, because it could be really expensive, especially if you're in a flood zone.
If you're in
which is basically Miami-Dade County.
Yeah, it's true. I mean, and that's where a good inspector comes into play, because that's going to tie into what your insurance rates are going to be.
So let's say you're paying, just an example, let's say you're paying $2,000 for rent, and then you're pre-approved for $600,000, and then with everything, your payments and everything, you're looking at $4,000. Maybe that amount is not a good amount for you to look at for homes. Maybe you should go lower.
Absolutely, and that's a conversation that you should bring up. If you're first off, your loan officer should bring it up to service, because that you don't want that to be an uncomfortable conversation later on when you're in contract. And all of a sudden, here's my loan estimate,
and then you're shocked.
And then you're like, what?
Which is like people fall off their chair.
100%. And I mean, here's a hardline rule: for every $500 that you pay in rent, you could afford just under about $100,000 in mortgage as a loan.
So
right?
If you're paying like $2,000 for rent, we're looking at like
$400,000, right?
And that's just for the
that's just the
mortgage payment,
right? That's just the mortgage
without payment. That is without like
doesn't factor in taxes, doesn't factor in HOA, doesn't factor in home.
That's huge, guys. I hope that like.
So just use that as kind of a barometer as to, you know, this is what I would feel comfortable paying. Now here's one of the tangible benefits of owning a property is you're going to build equity, right? But you also have your tax benefits, and I'm going to tell you the legalese is you have to consult the tax attorney and your accountant. But most expenses, when it's related to, or at least let me rephrase this: owning a home has a lot of tax benefits to it. So that $2,500 monthly payment that you make every single month is not $2,500 when you deduct the taxable benefit at the end of the year.
And interest too, right? Like you can get like a
100%. So you have mortgage interest that you usually can deduct. You have your property taxes that you usually can deduct. If you pay PMI, you also in most cases can deduct the PMI. And if you paid points, which is a whole different variant, usually that's deductible in the year that you've paid it. So again, consult with an accountant.
Accountant, realtor, mortgage lender, sit down with them, ask them questions before even beginning. That's why I put it as number one.
Yeah, it is.
Because if people just, they start looking for homes, then they get pre-approved, and then they don't ask questions, and then they end up putting an offer with, let's say, even a realtor that won't educate them on everything, they might become surprised or shocked, and then upset at the realtor, upset at the lender, upset at everyone. But
100%.
Protect yourself and make sure you ask questions before jumping into it.
Yep.
And another question I have is, and that goes into the whole educating yourself. What if people, because, I get that a lot. You American people, had the whole crisis. And
our Canadian neighbors.
The whole problem with the whole crash. And a lot of people went through bankruptcies and short sales at the time.
Yeah.
What if people had a short sale back then? Can they get a home now?
Yeah, in most cases you could. There's what we call waiting periods for short sales. In most cases, and this is going to tie into like a broad spectrum of products. This is not just going to be FHA and conventional, but
just like in general.
In general, the waiting periods are just a few years in most cases. If you had extenuating circumstances, and usually in extenuating circumstances, the 3 Ds, right? Death, dismemberment, or disability has to be very extreme. Death, disability, or dismemberment,
what
right?
Dismemberment? Like you lose a limb.
Like I lose a limb, and now I was a truck driver, or
I can't work.
I needed both my arms, and I can't work anymore. So those are extenuating circumstances. Losing your job and not having a job for a year or 2 years is not an extenuating circumstance, regardless
unless you have disability.
Right, exactly. So you have to prove extenuating circumstances. It can't just be that it has to be something.
Let's say you didn't have the 3 Ds, and then you had a short sale during the crash like everyone else, right? Like, would that be taken into consideration?
After a certain period, we don't take into consideration as a negative factor. You'd still qualify.
What about bankruptcy?
Bankruptcies as well. Bankruptcies have shorter waiting periods as well.
Isn't it like 7 years?
Depends on.
7 years.
Depends.
Guys,
You have.
talk to a credit repair person.
Yeah, you definitely want to.
Before going into bankruptcy.
When it comes to bankruptcy, there's different chapters actually, and the different types will actually have different rules. And I'm not going to go into that because it's very long-winded, but you have chapter 7, 11, and I think 13, if I'm not mistaken.
Hi, Caesar.
Each one has, what's up, Caesar? Each one has its own set of rules that may or may not allow you to get into a mortgage fairly soon after you.
And I think, guys, if things haven't changed, it's the same in Canada. Like you can get a mortgage, but after a certain period of time.
Yeah.
And even there's bankruptcy forgiveness, right? Depending on the chapter.
Depending on the chapter, and that's from a technical standpoint, they have that because you continue payments and you do all that stuff.
You know that?
Yeah, I do. So, well,
we're on
live.
Facebook Live.
How you doing?
Is that good or bad?
We're doing a Q&A.
Is that?
We're on Facebook. Yeah. We have Penelope. We have somebody. Say hi. Go.
How you doing?
Hello.
So we're talking about
Another
pre-approvals
awesome realtor.
with Compass.
I should come back later.
Yeah, we'll see you in a little bit. So basically, to touch back on bankruptcies and just what we call significant credit events, there are waiting periods, and that can get extensive. But basically, the waiting period can be as little as 1 year with extenuating circumstances, and as long as 7 years.
You have to make sure you have income.
You have to make
Meanwhile.
yeah, you do. You have to make sure you have the income. But there are again
legal
income that's reportable. There are alternative programs again that we have like day one programs where you can literally like the day after you go into foreclosure, you can get a loan. But again, you're looking at high interest rates and things like that. So unless you're really, really, really pressed to buy that home, we're probably gonna have to wait the extenuating period.
Okay, so guys, make sure that like I'm trying to find the vaut mieux prévenir que guérir in French. Like it's better to prevent than to heal. Like if you guys are going through financial troubles or if things are not going too well, make sure that you talk to your accountant, talk to a credit repair person, because things like bankruptcies and short sales, like they can be forgiven, but it can be also like it can delay things and it can make everything complicated. So it's better to take care of these things before the worst case scenario happens.
100%. It is. If you want to plan for the next couple of years, and if you can avoid something, or you can go into, let's say you can alleviate a short sale or alleviate a foreclosure by doing something or pre-planning, then do it.
Okay, I have another question that came on Instagram. What's the down payment for, let's say you already own a home and then you want to get an investment property, like as a second property or just investment, or what is the down payment for that?
So usually it's 15% if we're going to go to conventional.
15?
Yeah, 15%.
Why did I think it was?
If it's in the conventional space. So conventional in the state of Florida is $453,100. I don't know why that $100 is there, but that's what it is. Anything above that is going to be what we call jumbo. And that's where we have private investors, big institutions, institutional investors, and that's where the down payment is going to change. Most likely, it's going to be like 30% down. Now, we're talking single-family homes. Condo is a whole different animal.
Like 30%.
30%.
But okay, another thing I want to add is that condos in general, and not just condos, even townhouses.
Yes.
If there's there's townhouses that are like on the tax record as a condo.
Yes.
It doesn't work. The 3.55% down payment, usually not all, like there's little cases where it does work, but most of the time you have to put what is it, like 20, 25, 30%.
Yeah, so in the state of Florida, we're the only state that has this rule, but it's 25% down. So it goes.
And I know why we have this rule.
Yeah, I mean, because of the problems that we had, and so and it continued. Like the thing of it is this: when it comes to condos, I always tell people. It's a lot easier to get into the 25% down payment space than it is to the 5% down payment space, mainly because of the way the financials work and the requirements for getting condos approved. But without getting long-winded into that, if you happen to need to put 25% down on a condo, there are programs that allow you to put as little as 10 and still do a first mortgage for 75% of the purchase price.
But that gets complicated.
It gets very complicated.
It
gets very complicated.
Guys, like if you want to buy a condo, have 25% off.
Yeah.
That's it.
Yeah.
That's it. Unless you're buying a condo that is like advertised as, hey, we will finance. Like there's condos that went through reviews and everything with lenders already, and they're advertising it as like, Even I haven't seen lower than 10%.
No,
I
I mean,
guess advertised.
yeah, we've done condos, we've done approvals for condos less than 10%, but it takes a long time.
Just in your mind, just
Just
you
put-
know,
just be
for
prepared for
20.
25%
And the
down.
reason for that, what happened during the crash, is that people are still recovering from it,
100%.
and for years they wouldn't even finance condos at all,
No.
just because of people weren't paying the association. A lot of problems happened. So I always tell people, if you're buying a condo, put 25% down.
Yes.
Okay,
yes.
I'm gonna read a question.
I
How easy is it for a Canadian to purchase a house in Florida? How does it work in terms of credit? Does it have to be cash, or do we deal with American bank? Not sure if it was already asked.
No, it wasn't asked.
Hi, Michou.
That is a great question. That's a
Great question from Michou
So-
here in Montreal.
As crazy as it sounds, with Canada being our bordering neighbor, we recognize Canada as foreign nationals when they come and purchase properties here.
But before you go into that, I'm going to say something really quickly.
Go for it.
People in Canada, I'm going to say it in French. Okay, le monde à Montréal, vous pouvez Banque TD, Banque Desjardins, finance en Floride. Pas partout aux États-Unis, mais en Floride. Okay, so in English, Bank of Desjardins, which is a credit union,
Mm-hmm.
and TD Bank, and I think that RBC as well, donc RBC également, they will do a mortgage for you guys from Canada
here.
for Florida. And I'll usually tell Canadian people to go that route because it's so much easier to pay your mortgage in Montreal because
Yeah.
you're getting your paycheck in Montreal.
Yeah.
And another thing that I'll tell people is that if you can either refi your home or get a home line of credit in Canada and use that to purchase a condo here or like a property here, it's so much easier because you're going to get a better interest rate than the foreign national.
Yeah, 100%. And so for Canada, and I think Canada is one of the only places that has this particular rule where you can actually finance a U.S. property in Canada.
Mm-hmm.
So for that purpose, I would definitely recommend that you go there first because
Interest rate is lower.
Interest rate is lower, and usually the terms are a little bit better because the guidelines are used to working with Canadians because their guidelines are from the same domicile.
Everything,
Exactly.
Employment, and
Exactly.
It's totally different.
100%. But let's turn that question around and say, okay, what if I'm not from Canada but I'm from a different country, right? So it's very simple. Actually, a lot of my business when I first started was foreign national business. Ironically, I used to work for a bank that did a lot of that business. We still do a lot of that business now, and it's actually probably a little bit easier in a sense to finance foreign nationals than it is to finance our domestic clients and U.S. citizens. Mainly because here's the mindset behind that. Usually, if you're a foreign national and you can afford to have a property, a second home, you're pretty good financially, right? You're financially responsible. So what ends up happening is it puts you in a position where you probably have a decent amount of assets, but let's just talk specifics. Usually you need to have about 30% for down payment on a second home. It's very difficult to finance an investment property in most cases for a foreign national, but it's not impossible. You just need to usually have about 50% down payment.
50% is like worst case scenario.
Right.
For Canadians, it can be less depending on.
I've heard like 20-25% down for second homes.
Yeah, because it's easier to verify the income.
100%. And the risk is home. They have their own risk associated with that home. Whereas if it was somebody
in
Europe, let's say, right, they're looking to purchase a property here, down payment might be 30% on the second home. Depending on the second home, how do we, same factors still apply: credit, assets, liabilities, and income. But how do we qualify that? Credit, we would do a number of different ways. Most likely, we would do what's called an international credit report. Believe it or not, one of the biggest and largest international credit reporting companies is based out in Florida. So we use them a lot for our international credit reporting. Assets, basic assets, right? I mean, what we do is we do a currency conversion for whatever the country is. If the statements aren't in English, we just need to
get them
translated. And in liabilities, we're looking at whatever liabilities you have. Most cases,
they look more at assets.
Yeah, they look at most cases.
You can't verify that.
The liabilities, the only liabilities we really ever look at, because most times foreign nationals don't have debt. Because look, different countries look at debt a lot differently than we do in the United States.
So just to give you an example, it's way easier to get a home here than in Canada. Liability-wise, I used to work in mortgages, like in Canada, like
Yeah.
it's rare that people get something under 20%. Like here, I mean, I've seen,
Yeah.
because here the thing is people have like really bad student loans. Like in Canada, we don't really have that big of student loans, so like you don't have an excuse.
And I think we should talk about student loans a little bit.
Yeah, can you like briefly talk about it? I kind of like need to end this in like the next.
Absolutely. Yeah, absolutely. So basically, and if if I'm just to stay on that foreign national tip real quick, from an income standpoint, usually in most cases it's something as simple as an accounts letter that basically stipulates what you've made for the last. Listen to what I'm saying. Listen to what I'm saying. It is.
That letter.
We will verify that letter.
You can't give us.
It's not going to be like you can't give us a BS letter. It has to. It's going to be legitimate.
Them. The reason I say I've seen them.
We will verify it, but just think about this for a second. It's going to be an accountant's letter on accountant's letterhead that basically stipulates if you're self-employed, what you've earned for the last 2 years and what you're trailing for this year. If you work for a company, it's a lot easier. We usually just work with them on getting that letter. So that's behind us. The short answer is foreign nationals, we can get financed. In most cases, we can get them financed very easily. Student loans. Right now, student loans are the biggest.
By the way, Canadian people, Americans have student loans that are mortgages, literally.
Oh no. I've
mortgages.
$350,000 is.
You have?
Not me, no. $350,000 is the highest that I've ever had for a client, and it's bad.
Is it a doctor?
Yeah, it's a doctor.
Okay.
It's a doctor. But here's how we look at that. Student loans right now are a big hot topic because of the fact that the way that we look at certain lenders look at student loan debt is they're going to take whatever the outstanding balance is. Let's use a $350,000 example, right? Let's just use that because that's a real example.
My entire body hurts.
Yeah. We're going to use, in most cases, depending on the loan program, we would have to hit somebody for 1% of whatever the total balance is as a monthly payment. So that's $3,500 that we would have to hit you for. Now, if you go conventional, you can do something called income-based repayment. And when you're in your starting years as a doctor, we're using a doctor as an example here, but there are special programs that we do for doctors. But let's just say you have $350,000 worth of debt and you only make $60,000 a year. And those are real numbers. What happens is what you should do, first thing you should do is you should go back to the student loan servicer and you should say, look, I need to do something called income-based repayments. What they're going to do is
my daughter's going to school in Canada.
Yeah, I mean, she should because it's a lot less expensive. If not, it doesn't cost anything.
Okay.
So in that situation, the examples that I'm giving you, what you should do first is you should look at doing income-based repayment because income-based repayment, believe it or not, you can actually have an income-based repayment of $0. Okay, and as a lender on the conventional side, if you provide us something that shows $0, we're going to use it. We're not going to hit you for the $3,500 monthly payment that we would have to or be required to, let's say on an FHA mortgage. So it's very important, and we go back to pre-planning and understanding what you got, where you are financially. Student loans play one of the largest roles in why clients will not be able to get approved immediately. So if you start that pre-planning early enough and you start working with somebody, going into income-based repayment, getting a low,
change it, just making sure you change it up.
Just working and strategize.
And just paying it.
Yeah.
Because I've seen situations even with renters where their credit score is really, really low, like in the 500s, and they have great income. All their other credit cards are paid. It's just that they're late on their student loans. So it's better to work with someone to even lower it for you to be able to pay it, to actually, because it's not just going to affect your mortgage, but it's going to affect your credit, and it's even a rental you can't get. There's communities in Miami, and I don't think that's legal. They don't accept people under a certain. I don't think that's legal. For rentals, guys, you can't. Like, there's places you cannot get a rental, or even if you're an owner, is looking at 3 different offers, and one of the person has like 500 credit. Which are the ones you think they're gonna take, the 500 credit one or the 700, right? It can affect your credit.
It's all credit risk, and it is legal. I mean, some of the things that they put in bylaws are legal, which is crazy. But here's the point. The point is you want to be in a position to understand where you qualify for, because just if you make $300,000 a year, but you have $250,000 worth of expenses throughout that year, your net income for the year is $50,000. So it's important to understand those dynamics, and student loans can play into that and be a very large component as to why you won't be able to qualify for that $1 million home that you think you're entitled to, because on paper you make $300,000. So we're looking at the big picture, and it's important if you're going to start looking in the pre-approval stages, you want to get all those components: credit, assets, liabilities, income on paper. Now, to kind of sound off on the differences of pre-approval, because there are different types of pre-approval. You have your pre-qualification, right? Which is basically, we have a conversation now. Sarah, you make X number of dollars. You have X number
It's
of
just
in the
like
bank.
talking, but I can lie.
Right.
I can lie.
And, or you may think,
you know what, you guys, a lot of people, it's not that they lie, but they don't know.
No, it's most of the time, right? If I'm taking money out of my investment account, the stock market takes a dump, I'm not watching it. And now my investments are not worth anything near what I thought they were. Or my income, I just got that increase in my raise, or I just got that salary. We're not going to, exactly, it's not reflected on your taxes. We're going to do the income analysis a little bit better. If you're self-employed, the last 2 years you didn't file taxes for high income, but now you're like killing it this year, killing it. We're not using this year as income, unfortunately.
The other years.
We're
so
using the average.
You might have to wait or do the bank statement.
Right, or amend your taxes and file for higher income if that's what your income was. But the point is that pre-qualification isn't worth the paper that it's written on, to be very honest with you. There's also the second stage is a pre-approval. This is what we're talking about.
I only do like pre-approvals because pre-qualification, anyone can say things, and then when you send out the paper, the number is different.
100%.
So it's better to just send your stuff from the beginning.
And when we talk pre-approval is a little more intense, right?
Can you tell me like just a quick nutshell, like what they need to send?
Yeah.
To the
So
lender?
pre-approval usually is going to entail doing an actual application, pulling your credit. Then we're going to collect asset statements, and that's going to be 2 months of or quarterly asset statements for whatever type of assets you might have. If it's liabilities, we're going to pull the information from your credit report, and then we might need some supporting documentation for some of those liabilities.
Like tax returns too.
Right. For income purposes, we're going to need tax returns in most cases. If you're W-2, sometimes some loans only want W-2, so that's it. So usually it's pay stubs, tax returns, W-2s. And
what's a W-2?
A W-2 is basically your end of year earnings statement for when you work for a company. If you're self-employed, you usually get a 1099 statement, and you may, in some cases, file like Schedule C or 1120S, like a lot of realtors,
like
corporations. So again, accountants are better suited to explain these things, but this is what we look for on the lending side. So the pre-approval is basically us taking all these pieces of the pie, putting it all together from a document standpoint,
and giving you
running it through the system, and then giving a pre-approval. And then one step further than that, okay, is doing something called upfront underwriting, which you can.
That's like better. Because then what happens with the upfront underwriting, like me as a realtor, when I submit the offer, it is a stronger offer
100%.
because we know for sure that the lender went through everything and that the person is actually pre-approved for that amount.
100%.
And it'll put you higher up compared to other.
Yeah, 100%. And
we'll talk about that in the next weeks.
One.
Yeah, in the next weeks, yeah.
What ends up happening is you have confidence and you have competitive advantage.
Absolutely.
When you start doing the upfront underwriting. So basically, those are the 3 different types of pre-approvals. You at least bare minimum want to get an actual pre-approval.
Yeah.
Get documents together, send it out to your loan officer. So
do you have any other questions that you get, like maybe like one more question that maybe you get often that we didn't talk about?
So one of the questions that I get often is, do I need to have like co-signers, right? I can't afford this property by myself. I need to have a co-signer. All right.
Or people like, for example, like self-employed, this year you're killing it. You know that you're going to be able to make the payment, but you're only pre-approved for $200,000.
Yeah.
You know you can. So maybe you need a cosigner.
You might need a cosigner in that regard. So basically, like the way that short answer is, can I have somebody else on the application with me who might be able to help me in my situation? Absolutely.
Make sure that you stay cool with them.
Yeah, exactly, because they're gonna have financial responsibility for the property. But one of the other questions that I get, and as a generational gap, we're starting to see that kids might make a lot more money than parents do, and what ends up, and culturally, you might have your parents or your grandparents live with you, right? That's a real thing. One of the things that most people are they misunderstand is that if you're purchasing a property for your relative, or in this case, it's, mother and daughter or child and parent type of scenario, despite you owning a property already, you can actually purchase that property as a primary residence if that relationship does exist. So a lot of people don't know that.
Yeah, I didn't know that.
And
I didn't know that.
we've just rescued a deal last month because of that, because the lender just didn't know that. And it means, it is what it is.
Because it changes
because
everything. It changes
100%.
even tax-wise. And that's just one thing to add. Like when you have something as a primary residence,
Yeah.
tax-wise, you get a discount,
You
which
get-
is
you
called
get-
homestead exemption.
Yes, which is
So you
huge.
pay a bit less taxes. So,
Absolutely.
oh, this is huge.
Yeah, so this is why it's important to talk to your loan officer. It doesn't have to be me. We'd love it to be me, but it doesn't have to be. You just want somebody who is
If you have a
confident.
relationship.
You
with
have a
someone.
relationship. You have somebody that you work with in the bank. Just sit down and talk to them about what your planning is and what you really want to have as an outcome.
And then you can establish a plan.
That's it. That's
Yeah.
it.
And you know what? If you have more questions, just add William to Facebook. What's your name on Instagram?
So-
Will Caban, the mortgage man.
Yes, Will Caban, the Mortgage Man. So you can find me. You can find me on Instagram at Will Caban, the Mortgage Man. You're gonna see more content on Instagram than you will on Facebook. But you can always reach out to me, ask me any questions.
And reach out to me too if you guys want like more information too. Just if you guys just don't know where to start. I'm no longer the fancy realtor on Instagram.
I noticed that today.
Yeah, I'm Sarah Desamours only. Like I'm not, because I'm not like I'm fancy and everything.
She's still the fancy.
Yeah,
realtor.
but once in a while, like I have, if I'm showing properties all weekend, I'm not fancy. But Sarah Desamours. Like if it's too hot, guys. Like I can't, it's
Summertime.
really really hot.
Summertime.
Yeah, if you guys have any more questions, just message William, or if you have a relationship with a lender or with a financial advisor,
Yeah.
those are people that can help you too in the planning. Make sure that you plan before you execute.
Yeah.
Okay.
Don't.
And do it with professionals. Some lenders unfortunately don't always take the time to explain things to their clients, and then clients end up with something they can't afford or
Yeah.
that they regret. So make sure it's better to hear something that will hurt your feelings
Then.
than
to
you
actually-
already have the home and then your feelings are hurt for like 20 years.
Yeah,
So-
yeah. Or you see that loan estimate and see the payment is $1,000
And
more
then
than you
you faint and
expected.
then start getting high blood pressure and things like you don't want to. You want to get that. You want to make sure you know everything from the beginning. So
Yeah.
it was great talking to you guys. If you guys have any more questions, again, message us and we'll be happy to help you.
Take care, guys. Thank you
Okay,
so much.
bye.
Bye-bye.
Bye bye. Okay, that was awesome.
Yeah, it was.
I think I'm still on Instagram and live video.